Good morning, everyone. You are watching a live daily market outlook for Monday, 2nd of April 2012. We are at the beginning of the new month, as today is the first day of the week and first working day of month of April, with the week being quite busy regarding the events that are due to be released, with special focus this week on U.S. Non-farm payrolls that are due on Friday, 6th of April, despite it's going to be a partially market holiday as the Good Friday falls on this coming Friday, but US is going to release their non-farm payrolls, the key release of this week. The sorting out trends in the US labor markets became a tricky business these days. Basically, there are plenty of evidence to support the view that unemployment is stalled at 8.3% for much of the year, and the case to argue that job growth is poised for takeoff. Three interlocking factors are seen in play: the pace of productivity gains, size of the labor force, and the outlook for GDP growth. Dial any one factor up and it can change the jobs outlook significantly. The consensus for March employment data that are due, as I said, this Friday is 201,000 new jobs were added outside the farm sector, a downshift from 245,000 average monthly pace in the United States has enjoyed since December. This would hold the jobless rate around its current rate of 8.3%, unless a surge of people who had been discouraged flood back into the labor market again and again start looking for work. The optimistic school of economics forecast that job gains could be as high as 275,000 in March and reach 300,000 new jobs a month by later this year. The productivity surged after the recession, reaching a 6.1% pace in 2010 before hiring started to kick in, and then it fell back last year to 0.9% by the fourth quarter, repeating a pattern seen after the last three recessions. Yet GDP growth appears to be holding around 2 to 2.5% in the January to March period, roughly its trend rate. The only way national output could remain firm while the number of widgets produced per worker was falling is if more people are working. So this is one of the events that will be watched closely. Also, we're going to take a look at the today's events and see what are the things that we are going to see today. Already released the Japanese Tankan Manufacturing Index that came at disappointing -4 compared to 0 consensus, showing that the economy is again struggling. From Australia, we had the inflation gauge that came at 0.5% compared to 0.10% of the previous week, and Australian building approvals came in very disappointing, -7.80% compared to 0.60% forecast and 0.90% of the March of January. From Eurozone, from Europe actually, starting with Switzerland at I think it's been already, pardon, at 8:15 GMT, yearly retail sales for February decreased from the previous release of 4.4. It's at 3.2%. Swiss PMI comes 15 minutes after, and still disappointing as holding below 50, but better forecast for today, 49.5 compared to 49 of the previous one. Italian unemployment rate is expected to raise on monthly basis to stay unchanged on monthly basis at 9.20, while quarterly for fourth quarter of 2011 is expected at 8.6 compared to 8.1%. From UK, the awaited manufacturing PMI for March is due at 9:30 GMT, 50.6, again decrease from 51.2, showing another easing. However, still holding below 50. That is quite supportive. Unemployment rate from Eurozone forecasted to tick higher. 10.8 is forecast for today compared to 10.7% of the previous week. And then again, PMIs from US manufacturing PMI March released due at 1500 GMT. 53.3 is the forecast for today compared to 52.4 of the previous month. Construction spending on US March release at 0.7%, better than the previous negative at minus 0.1%. ISM manufacturing prices March at the same time 63.2, improvement from 61.5%. That was from events due today. Now we're going to take a look at the markets and see the latest movements since the market opened in Asia. As we can see, the euro still remains in the positive path as the overnights gap higher opening and the jump higher hit 133.75, which is approximately the ceiling of this past couple of days range. But quick reversal covered the gap and dipped down to 133.30, where the temporary floor was found, contained by 55 days exponential moving average on the hourly chart. Some action higher was seen in the early hours of European 1 to 133.55, but it seems that at least on hourly chart the pair is losing strength, and as the studies have started pointing lower, and the loss of momentum sees the risk of further ranging at this zone. It is important to hold the initial support at 133.30 and 133 zone, where is the low of intraday low of last Friday, as well as main bull trend line drawn of 130.00 base that for now holds the downside. And only break of this support might risk some stronger pullback with the next very strong and important support at 132.53 higher platform of last Thursday. And basically only loss of this level just above this is 4-hour chart 55 days exponential moving average, currently at 132.84, and loss of these levels might signal a temporary top at 133.84, which was the high of last week, along with these levels at 133.75. That is capping the upside for now and will allow for a deeper reversal from Fibonacci levels we can define now. In case of break lower, what we'll be looking for, it's 132.38 comes next. In case of break of 132.50 zone at 132.38 is 38.2%. On the upside, if the pair holds above 133.30 and the possible attack higher, would be looking for clearance of this congestion at 133.75, 133.84 for possible resumption of the broader uptrend, and the latest leg of 130.00 to open way for test of first barrier is 50% retracement of the longer term downtrend from 142.46 end of February 2011 peak down to 126.22, which is the beginning of January 2012 so far yearly low, and then our key short-term barrier at 134.85 that marks end of February double top. Situation on the daily chart is more positive as all studies are firmly above their midlines, and the recent break above the main bear trend line of 142.46 and the gains holding steady above this with weekly close above this broken trend line keeps gives more positive sentiment to the pair. However, we need to see the clear break above 133.84, 134.00 in order to resume this positive structure and the open way for test of our next key barrier at 134.85, above which will come 200 days moving average, currently at around 136 zone. It's a bit far from these points, but break above 134.85 will definitely focus this level. As said, the studies on the daily chart are positive, while hourlies are rather neutral at this point, while the 4-hour and the hourlies are losing strength and threatening of further easing. Immediate support 133.30, 133.00, and a very strong one at 132.50, below which might put aside the current upside action and allow for a stronger reversal. The cable is in positive mood this morning after initial opening, gap higher opening, tested the level at 160.25. This was the overnight's high, just ahead of last week's fresh peak at 160.36. This was on last Friday, when the pair finally broke above 159.91, 160.00 barrier, and so far extension reached 130.60.36. Subsequent pullback of overnight's high, previous high, was contained at previous strong support zone at 159, 159.80. As the pair dipped down to 159.79 ahead of the fresh strength that posted fresh high of the day, and at 160.40. This was in the early hours of European trading. Improving hourly studies see potential of further extension higher. However, brief loss of momentum at this point might see further hesitation around this zone, with the 4-hour structure being more positive and seeing more potential for extension of the latest up leg from 156 base of 12th of March 2012. 20 days exponential moving average currently at 159.62 underpins the latest action, while situation on daily is looks more positive, with studies firmly holding above their midlines, and last week's break above 200 days moving average and sustained the break above this level, keeping the upside in focus. Extension higher that will target our next upside barriers at 160.90 and 161.00, which is the high of 14th of November 2011, and 161.00 is the round figure resistance, ahead of more significant ones, 161.29, the high of 8th of November 2011, and the most important one, 161.64, high of 31st of October 2011, also 61.8% Fibonacci retracement of the broader downtrend from 167.45, high of 2011, that bottomed at 152.33, which marks the low of 2012, posted on 8th of January 2012. So the daily structure remains positive and sees potential for further gains, while also the 4-hour studies are quite bullish. The only thing is so far hesitation at this barrier at 160.35.40, as hourly studies are currently losing momentum. But as long as the overnight's low at 159, last Friday's low at 159.65 and overnight's low at 159.80 hold the downside, along with the hourly 55 days exponential moving average at 159.70, the scope remains for a fresh push higher and possible break above 160.40. That will open 160.90, 161.00. For now, I would say the only break below 159.20, 159.00, as shown on the hourly chart, where is the 55 days hourly moving, 4-hour moving average, and 159.20, which marks the previous high of 21st of March, would more significantly weaken the current structure. Otherwise, holding above these levels keeps the upside, near-term upside, in focus. The dollar yen is in a recovery mode after a reversal of 84.17, recent high of 15th of March, dipped briefly below our important support and the break point at 81.95, 81.85 as the pair's price hit 81.82 last Friday, followed by a sharp correction higher and bounce higher. The important is that the price regained the first 82.60 as initial barrier, and then 83.00 as the previous range floor that was tested before last week, actually last Thursday's bounce higher hit 83.38 ahead of this weakness. Overnight's gap higher opening keeps some positive tone in play, despite the pair nearly fully reversed. The gap 82.74 was the 82.87, 82.90. So approximately the gap has been covered so far, as the gains stalled at 83.29, just ahead of 83.38, our initial target, and basically break above this level needs to sideline the immediate bears and open way for possible extension higher and test of 84 zone peaks. For now, the hourly studies are still in the positive territory, as long as holding above 83, 82, 80, what is the 20 days exponential moving average. Studies are still in the positive, but started pointing lower. That might risk a further easing situation on and 4 hours is improving as they're coming from the negative territory. However, a failure to break above the midlines might risk further easing. For now, I would say as long as the 83.38 holds the upside, there is a risk of further easing, especially that structure on the daily chart is negative, and all studies are pointing lower, with momentum testing its center line. That might signal further correction of the recent 76.00 to 84.17 strong rally, as there was no significant correction during the 2 months rally, just few corrective brief corrections, and now this looks like a more serious move lower. And as long as 83.38 holds, I would say that possibility of a fresh attack at break point at and the low of last Friday at 81.85 zone would be the likely scenario, break of which is to open way for further retracement of the latest rally. And the next level on the downside to watch is 81.05, which marks 38.2 retracement of 76.00 to 84.17 rally. Dollar Swiss remains more under pressure, as the overnights, as shown on the hourly chart, gap lower opening, dip to 90.00. This was our next target after break below the higher platform at 90.15, where the losses were held for a couple of days, and the failure, upside failure at 19.91. This was a high of 29th of March, last week's actually high, ahead of fresh weakness. Situation on the hourly chart remains, I would say, negative, and it keeps the downside vulnerable, as overnights and this morning's bounce was contained at 90.30, just under the 55 days exponential moving average at 90.35, and the more significant barrier intraday high of last Friday at 90.43. And as long as these levels hold the upside they capped, there is a scope for a further extension lower, especially that, as I said, the studies are negative on the hourly chart. On 4 hour, also have more negative structure, as 20 days exponential moving average directly caps the corrective attempts higher, ahead of more significant 55 days at 90.72, and the last Thursday's high at 90.89, with basically only break of this level along with the 90.70 previous resistance to open way for some more significant correction, but is still seen as corrective, as the situation on the daily chart shows the weakening studies holding below their center lines. as the pair broke below the short-term bull trend line drawn of 89.30 double bottom. That was clear that 90.20 and the holding below this broken trend line keeps the focus on the downside, as studies are negative, as I said, on the daily chart. Immediate focus below 90.00 comes at 61.8 Fibonacci retracement of the broader up move from 85.66 end of October 2011 low to 95.93 peak of so far high of 2012. That was posted on 9th of January 2012, ahead of our key short-term support 89.30 double bottom of end of February, below which comes the next very significant dynamic support, 200 days moving average, currently standing at 88.50. As mentioned, to ease the current bear pressure, we need to see clear break above 90.91, 91.00, then more significant highs at 91.77. That would avert immediate downside risk and open way for a stronger recovery. Break above 91.77 is to focus the bear trend line drawn of the top 95.93, currently at 92.50, and the significant resistance at 93.30 zone, highs of 14th of March 2012. Brief look at gold so far, starting with the Fibonacci, with the Ichimoku studies. As we can see, the latest recovery has been held off recovery of 1628 low of last week, 22nd of March, has so far been held by the daily Ichimoku cloud base. That gives some positive structure in the near term, as shown on the hourly chart. 16 bounce of a bounce of 1628 peaked so far on approach to 1700. Our next significant barrier at 1697, and subsequent easing dip down to 1645. Current action higher is attempting to break above last overnight's high at 1674. That's currently attacking the moving averages at around 1669. Support, dynamic support, also static support, previous range ceiling. Holding above this level might keep the near-term action of 1645 in play for further extension higher. However, the broader picture on gold remains quite negative, as studies are still holding below their midlines, and the pair broke below 200 days moving average. But the main bull trend line of 1522 low of 29th of December 2012 is still keeping the downside protected, as there was a brief break last week at 1628. The gold price quickly recovered. Now we need to see the regain of 1690, where is the 200 days moving average, and the 1700, the previous high, and the psychological barrier, in order to sustain current bounce of 1628 and open way for a stronger recovery. Otherwise, risk is seen on the attack at 1645, where is also the trendline support that will further weaken the structure and basically break below this congestion at around the 1630 zone is to open way for further easing. 1624 is also the 61.8 retracement of 1522 to 1690, to 1790 ascent. A quick look at oil that is in defensive in past a couple of days. Let's start with the daily chart to see as the upside remained capped despite away from the previous peaks. It's 110.53 and 109.90. The main range ceiling was around 108.60-70 zone, where the gains were capped, and the fresh easing and break below the short-term range floor at 104.34 has weakened significantly the structure, as the price dipped to as low as 102.20. The studies on the daily are weakening. The MACD is now breaking below its midline, and the loss of momentum keeps the downside more vulnerable. Break below 55 days moving average has been so far contained by 90 days moving average, currently standing at 101.90, but range previous range ceiling at 103.70 has been taken out. That might signal upside intact for now and open way for a further easing. As I said, the studies on the daily are still in the negative territory. 4-hour chart is extremely negative, and as the studies reach their extreme lows, and this might signal, though not yet firm recovery signal, this might signal some a stronger corrective action. This is already underway of 102.12 as the pair bounced to 104.11, but the studies are still negative and just started pointing higher. This might signal some a stronger reaction higher. 104.12 is the 20 days moving average that along with the previous high at 104.11 offers initial resistance ahead of 104.30 previous range floor, break of which is required to open a way for a more significant recovery. On the hourly, there is, I would say, rather negative tone at this point, as the price action is entrenched within 102.80 and 104 range. More narrower range is 102.80, 103.50, and currently no firm signals of any movements higher. I would say on the downside, break of below minimum 102.80 to refocus 102.12, while above static barrier at 104.11, what is also close to it is the 55 days moving average, is to signal some stronger action higher. As said, quite negative situation, quite a neutral situation currently on the hourly chart, while 4 hours is still negative and just started pointing higher. Overall outlook for crude oil remains negative, as the pair broke below its main near-term support at 104.30. Thank you for attending. This was all for today. We're back tomorrow morning at the same time at 8:00 GMT. Have a nice day.